Hi everyone, this is Matt from Matt Strats. In this video, I'll be giving you an introduction into the world of options trading. From first-hand experience, I can tell you options may seem overwhelming and complex at first, but once you figure out a handful of key points, they are actually easy to understand. My hope is that this guide helps you get one step closer to feeling comfortable with options trading. When utilized properly, options can generate income, hedge market risk, and offer advantages that trading stocks alone cannot. An option is a contract giving the buyer the right, but not the obligation, to buy or sell the underlying asset at a specific price on or before a certain date. Typically, the underlying asset is a stock or an ETF. Options are known as derivatives because they derive their value from an underlying asset. One option contract represents 100 shares of the underlying asset. Due to this notable leverage, options should be traded with caution. Trading this asset class can lead to both considerable gains and considerable losses. Options are not suitable for everyone. The cost of an option is referred to as its premium. The premium value is greatly impacted by the strike price and the expiration date of the option contract. The strike price is the set price at which the contract can be exercised. The expiration date represents the last valid date of the contract. There are two types of options. A call option gives the owner the right to buy a stock. On the other hand, a put option gives the owner the right to sell a stock. To better illustrate these concepts, let's explore some examples. Let's say there's a stock, XYZ, which is currently trading at $100. You feel confident that the stock will be going up over the next 6 months. This prompts you to buy a call option for $3 on XYZ with a strike price of $105 and an expiration date in half a year. This means when the contract expires, you have the right to buy 100 shares of XYZ at $105 per share. Let's fast forward 6 months and say XYZ is trading at $120. Any value above $105 would be referred to as being in the money. Since you have the right to buy the stock at $105, you would profit the current value of XYZ, $120, minus the strike price, $105, minus the premium, $3. Therefore, you would profit $1,200, or $12 per share multiplied by 100 shares. If XYZ is trading at or below $105 when the option expires, known as being out of the money, you would lose the full value of the premium, $3 times 100 shares, or $300. A put option would be the exact opposite. Let's say there's a stock, ZYX, which is currently trading at $50. You feel confident that the stock will be going down over the next 3 months. This prompts you to buy a put option on ZYX with a strike price of $47 and an expiration date in a quarter of a year for $1. This means when the contract expires, you have the right to sell 100 shares of ZYX at $47 per share. Let's fast forward 3 months and say ZYX is trading at $40. Any value below $47 would be referred to as being in the money. Since you have the right to sell the stock at $47, you would profit the strike price, $47, minus the current value of ZYX, $40, minus the premium, $1. Therefore, you would profit $600, or $6 per share multiplied by 100 shares. If ZYX is trading at or above $47 when the option expires, as in it's out of the money, you would lose the full value of the premium, $1 times 100 shares, or $100. I hope this video offered you a concise introduction to options trading. I would highly suggest studying concepts such as selling options, option Greeks, and the impact of volatility on option premiums to continue your options trading journey. Do you have any questions about options trading? Let me know in the comments below. I would love to hear from you.